Investment in oil stocks versus agricultural stocks. Which wins in 2025? What if you had to pick one sector in 2025, oil or agriculture, to position your portfolio for the next decade? On one side, oil stocks, tested, global, with massive cash flows. On the other, agricultural stocks, essential, growing, and digitizing fast. In this video we'll compare both, looking at recent developments, industry data, and key companies in each field. By the end you'll have a clearer picture of which asset class deserves your attention now. Oil is no stranger to cycles, and in 2025 we're seeing some interesting moves. For example, major integrated oil companies like Exxon Mobil Corporation and Chevron Corporation continue to generate billions in free cash flow even amid volatile prices. Recent data shows these companies returned huge amounts of capital to shareholders and remain profitable despite the global energy transition headwinds. On the supply side, crude inventories in the U.S. have periodically drawn down while global non-OPEC production is rising. Because of these dynamics, oil remains relevant, but the risk profile is shifting. So oil remains alive, strong cash flows, dividends, but also structural risks, energy transition, demand deceleration, geopolitics. Now turn to agriculture. It's often overlooked by growth investors, but that might change. Here, think of companies like Deere Company, known for its farm equipment and expanding into precision agriculture and digital farming. Or Corteva Incorporated and Nutrient Limited, companies in seeds, crop protection, and fertilizers. The motley fool. The fundamentals: rising global food demand, technological adoption in farming, and inflation in commodity input costs. So agriculture is shifting from steady but boring to essential and evolving. Let's compare critical factors. Growth potential. Oil, Exxon, Chevron moderate growth, demand growth predicted to be modest. Agriculture, Deere, Corteva, nutrient export volumes rising, tech adoption increasing, structural food demand remains strong. Dividend/cash flow. Oil, strong cash generation, large dividends, Exxon and Chevron illustrate this. Agriculture, growing, but many firms still investing heavily in tech and expansion. Dividends typically smaller or less emphasized. Risk factors. Oil, vulnerable to energy transition, supply overshoot, geopolitics. Agriculture, climate risk, volatile commodity prices, input cost inflation. Innovation and structural change. Oil, some transition projects, carbon capture, hydrogen, but core business is mature. Agriculture, newer frontier, digital farming, autonomous equipment, yield optimization tech. Here's how to interpret current developments. In oil, the large cash flows and dividend strength are attractive, but rising supply and decelerating global demand growth mean you need selective picks, like Exxon, Chevron. In agriculture, companies like Deere and Nutrient are benefiting from innovation and structural demand, offering a blend of growth and resilience. If you favor income plus established business, oil might appeal. If you favor growth plus structural transformation, agriculture could be the surprise winner. You don't necessarily have to choose one. Smart investors often use both to diversify. Consider core income from oil, high quality, cash flow strong names, Exxon, Chevron, and hold through cycles. Add growth tilt via agriculture. Companies embracing tech, Deere, Corteva, Nutrient, for expansion into higher yield markets and innovations. Monitor macro factors, energy policy and climate regulation for oil, food supply chain, tech adoption and farming climate for agriculture. Use asset allocation. If you expect global economic recovery and higher energy demand, increase oil weight. If you expect structural growth in food and agtech, tilt to agriculture. So which wins, oil or agriculture in 2025? The honest answer: neither wins outright. It depends on your objective. If you want income and proven cash machines, oil has merits. If you want growth, transformation and structural tailwinds, agriculture is emerging. The smartest move: blend both wisely. If you found this breakdown valuable, hit like, subscribe and turn on notifications for Next Gen Finance, where we turn sector insight into actionable investment ideas. Thanks for watching. Stay sharp, stay diversified, and invest with purpose.